We're going to look at Kodak, and Kodak stock has been up crazy today. It was up almost 500% earlier. I think it's up about 350% right now. The reason the stock has soared so much was because President Trump has asked the company to produce ingredients in generic drugs in response to coronavirus. The government awarded Kodak a $765 million loan to start producing these ingredients. This is just a loan, but it could be the start of something new for Kodak. They may get into the pharmaceutical business and redefine what they're doing. That's kind of a big leap. So what I do in my videos is I run my discounted cash flow model to try to figure out the intrinsic value of a company's stock. Then I look at their financial ratios and compare them to its competitors. And I do this with you throughout the entire video, so it's like we're doing it together. Let's get started with the model. This company has a market cap of $1.26 billion. And they're trading at 36.20. It keeps changing. I'm gonna put 37. It was 40 a half hour ago. Now we're gonna pull the free cash flows, and the way you value a company is you estimate the future free cash flows and discount that number back to today's value. And every year they have negative free cash flow because they're leaking cash, which is not a good sign. Now we're going to pull the net income, which is a profit and loss on the income statement. And that's positive every year because net income uses accounting and you can kind of trick the numbers into making them positive. And then we're going to pull the revenue, which is always positive. Kodak was the big thing in the 80s before cell phones, when everybody used those cameras to take pictures. So you can see the numbers don't look so great. Every year negative free cash flow, 1 year negative net income, and their revenue has been declining every year. The stock is probably going to be valued close to zero, but I use a different model for this deal where I'm assuming a significant growth in the next few years. I don't know if that's going to happen, but I'm going to make that assumption based off of what's happening now. Let's get their interest expense. That's the interest they pay on their debt. That's $16 million. Let's go to the balance sheet to see how much debt they have. We need to figure out the capital structure of the company so we know what discount rate to apply to the future cash flows. Current debt is $1 million. Long-term debt is $105 million. And they pay 15% interest on their debt. So pretty hefty interest rate. And let's get their effective tax rate since debt payments are tax deductible. And most years they had a tax refund, but we'll do the 2016 where they had $78 million of income and $32 million in taxes. That brings the cost of debt down to 8.9%. Now let's get the beta. So beta of 1 means the stock moves with the market. S&P has a beta of 1 because that's the market. This stock has a beta of 2.59. So the stock moves a lot relative to the market, 2.5 times what the market does. Generally, a high beta means the stock is risky. Let's go back to the balance sheet to get their current assets. Current assets are mainly cash, accounts receivables, and inventory. And I need current assets to calculate the current ratio later, because we're going to look at the ratios at the end of the video. Current liabilities is how much money the company owes within the next 12 months. That's $368 million. And the equity is $281 million. That's total assets minus total liabilities. That's what the company's worth according to the balance sheet. And let's get their operating income. That's negative $66 million. Let's look at the capital structure. The cost of debt is 8.9%. The weight of debt is 27%. The cost of equity is 22%. The weight of equity is 73%. And their WACC is 18.5%. And the WACC is a blend of the cost of debt and cost of equity. And that's a discount rate we're going to apply to the future cash flows. So we estimated 4 years of future free cash flows. We also did a terminal value, which is all years past year 4, and that's 2.8 billion. As you can see, the estimates are much higher than the past because I used a really aggressive model, assuming a lot of things are going to occur. I normally wouldn't use this type of model with a regular company. Now I need to discount these cash flows back to today's dollars using the weighted average cost of capital. That's down here in green. And the value of the company is $3.2 billion. I divide that number by 34 million shares, and I get an intrinsic stock price of $94. It's trading at $37, so it's trading at a 61% discount. So it is a buy according to this really aggressive model. Although in my other models, the value is 0. I could show you if I change my model to number 1, it's 0. Number 2, it's $1.56. Number 3, it's $4.62. Simply Wall Street doesn't have a value for the company. They say no analyst is forecasting or covering the stock, and that's how they get their value, is from other analyst estimates. So they don't have any information to come up with an intrinsic value. Let's look at their financial ratios. They have a good PE, a good price to sales, and an okay price to book. PE is stock price over earnings per share, and that's 10.9. And earnings per share is net income over shares outstanding. I like to see below 15, and they have 10.9. So when the stock was lower, when it was like $5 a couple days ago, this ratio was even better. So it still appears to be a good ratio, given the amount of income they're bringing in. And they have a good price to sales ratio, that's stock price over sales per share. And to get sales per share, that's revenue over shares outstanding. And when a ratio is 1 or below, it's considered really good value. And even though their stock price is high, they're still at 1. So that's a good sign. Their price to book is a bit higher than what I like. That's stock price over book value per share. And to get book value per share, that's equity over shares outstanding. They have a good current ratio and a really good ROE. Current ratio is current assets, 706 million, over current liabilities, 368 million. And then ROE is net income over equity, so they're providing their equity holders a great return. They have a negative interest coverage ratio because they have a negative EBIT. And the best way to look at ratios is to compare them to similar companies. I've done videos on Global Payments and Wilhelmina, and they're in the same industry as Kodak, although quite different companies. And Kodak has the best PE of the 3 companies. They're better than the average in price of sales. They have the worst price to book ratio. They have the best current ratio and the best ROE. They have the most debt, although 27% isn't that bad. And their market cap is in the middle of 3 companies. So it's an interesting company to look at. Maybe it'll be a new company, Kodak, a resurgence of doing something different. Let me know what you think of the video. Thanks for watching.